We called this DATS versus ETFs Celebrity Deathmatch, so I had to look for what it's actually called. Competing Gateways for Institutional Capital. I'll make some quick intros in the interest of time. This is Jaime Leverton to my immediate left, CEO of ReserveOne, a diversified digital asset treasury company offering both capital appreciation and staking income, expected to launch Q1 2026. Just double checking. I wanted to make sure I didn't screw this up. To her left, Brian Rudick, Chief Strategy Officer at Upexi, the first Solana digital asset treasury company. He'll have a lot of interesting things to share with us. To his left, Scott Gralnick, Head of Growth at Marinade Labs, a non-custodial Solana staking provider. And at the far end, Matt Hougan, Chief Investment Officer of Bitwise, a crypto native asset manager offering ETFs and SMAs and also a couple of bespoke strategies. So to begin our conversation, Matt, I wanted to ask you, from an investor's perspective, digital asset treasury companies, for heretofore we'll call them DATs and ETFs, are complementary tools and kind of an investor's set of ways to deploy capital in the market. From your perspective, for which investment objectives do you think DATs are a superior tool, and for which investment objectives do you believe ETFs are superior?
Absolutely, great to be here. I should say from the start, I think I'm supposed to represent the ETF side, but we offer an ETF of DATs, so I don't know where I am. I think I'm wrestling myself in this celebrity death match. Look, ETFs allow you to make a very simple investment in the underlying asset. You're making one bet on Bitcoin, on staked SOL, on ETH. DATs make more complex bet. You're betting on the underlying asset, you're betting on the execution of the management team, and then you're betting on the public's perception of that execution. That's necessarily riskier, which means you should demand higher risk-adjusted returns. So I think of them on a risk spectrum, with ETFs being simple and lower risk, and DATs being more complex with more upside, but also more risk.
Brian, anything to add there?
I would just second that point on it being higher risk, higher potential reward. When you do invest in a DAT, there are additional risks that you're taking on. One is potential MNAV compression. For instance, you can buy in at 1.2, and maybe that moves down to 1 or even at a discount. I'd argue that it could also move up, which is what we've seen historically when we move into a full bull, but you're taking on that tracking error, shall we say. In addition, there is a potential for a DAT to be a forced seller at exactly the wrong time. I'd again argue that leverage is probably something that is good if you believe long-term in the underlying, but you have to make sure that you're with a DAT that is only taking on prudent leverage. But what actually gets me so excited is there are these additional value accrual mechanisms that you can get with a DAT. The big one is intelligent capital issuance, so MicroStrategy trading at 2 times. When they issue equity there, they are effectively selling $1 for 2, or they're buying Bitcoin half off. It's literally how they created 26 billion of free Bitcoin for shareholders. They call it Bitcoin yield, and how they've more than doubled the return of Bitcoin since they launched in 2020 with very minimal leverage. So there is some true underlying value creation there, and then there are these additional value accrual mechanisms like buying locked tokens at a discount for built-in gains for shareholders. So I would argue that if a DAT is successful, it could put up really great risk-adjusted returns, but you're also taking on more risk.
That's an excellent segue into our next question, Jaime. DATs, in some senses, can be compared to hedge funds, but arguably with a superior cost structure from the perspective of an investor, given the typical 2 and 20 setup at a hedge fund. But public hedge funds have been relatively poorly received by the market. That's not necessarily been a theme that the market has kind of supported. Could we see DATs offer investment strategies in the style of hedge funds on a going forward basis? And do you think that this would be a good thing?
Well, look, I think the nice thing about DATs is there's tons of optionality. Not all DATs are created equal in any way. I think crypto hedge funds in particular have had a capital formation challenge in the private markets, which a public market setup is obviously a solution for that capital formation challenge. In the case of what we're doing at ReserveOne, we're the only scaled diversified DAT, so expected to be 80% Bitcoin, 20% alts. But then we also have the embedded structure or optionality to allocate up to 10% of AUM into high conviction venture opportunities or private market opportunities. So not exactly your typical hedge fund model, but certainly the ability and opportunity to give investors access to things that that they couldn't naturally get in a typical equity.
May I ask, Scott, excuse me, while most ETFs are structurally similar, DATs do, as Jaime just mentioned, vary fairly widely in how they're set up and how they expect to go forward. How should investors think about the breadth of DAT operating models given the commonality in their stated goal, which is this idea of maximizing the underlying token or tokens per share?
You know, at Marinade, I feel very fortunate because I get to sit in between both the DATs and the ETFs and ETPs. So fortunately, I get to work with both Bitwise, Upexi, and hopefully one day Jaime. But for investors, you know, when working with a DAT, you have to look at how the validators are set up, how distribution is, what have the companies done for smart contract audits. It's a very different setup than when talking with a traditional hedge fund for investments. But for the ETFs, it's sort of a set it and forget it type of situation, where the DATs, there's so much more creativity, but also risk at the same time. So for the DAT investors, it's really important to see distribution, the validator set up, if there's single validator risk, what type of insurance protocols are set up for those validators. You know, one of the things that Marinade does extremely well is we have a delegation protocol that for hundreds of validators that work with us, each one has to put up a bond to guarantee downtime. God forbid something happens, we can guarantee that APY. Also for creativity, if, you know, say one DAT is less risk averse, they could keep the principal there, use the rewards in a composable way with the protocol, if Solana, do something on Camino or do something with Sanctum with different LSTs and start playing around for a much higher yield. But I think right now, starting off for the DATs, it's going to be about the infrastructure security, the management team, and how distributions are coming back.
Can I throw in two thoughts, Cactus?
Yeah, sure, of course.
I think people aren't thinking obvious things, which frustrates me in the DAT space. One is that companies are rewarded for doing hard things well over sustained periods of time. And DATs will be rewarded or punished whether they can execute on something hard on it for an ongoing period of time well. Some will and some won't. And I think people should just keep that in mind. They're going to be very different outcomes. They shouldn't be rewarded for buying an asset, putting it in a box, and even just staking it. That's actually not hard. Like, that's what I do in my ETF. I work very hard, but that part is not that hard. So hard things sustained over a long period of time. The other analogy I would make is people should think about this a little bit like active management versus passive. You talked about DATs versus ETFs. ETFs are passive management. What do we know about active management versus passive management in the traditional markets? Most active managers underperform and some dramatically outperform. And I think that will be true here too. I would suspect maybe even the median DAT underperforms ETFs, and then very high quality DATs dramatically outperform. There's nothing new in finance. This is not a new thing. It's just people aren't applying these kind of basic lessons to the space.
That's an interesting observation. Thank you for that. And switching gears real briefly to ETFs, I looked up, I believe the statement is correct according to ChatGPT, but roughly 2% of gold is held by ETFs. I think the number for Bitcoin specifically is closer to 7%, and another roughly 5 or 6% of Bitcoin's held by DATs. With the growing access of Bitcoin across consumer products, we're really referring to announcements we've seen recently, for example, from SoFi, and I think that we're probably at the early stages of opening up far more channels for consumers to individuals to get direct access to Bitcoin. Do we think that we're nearing the peak of Bitcoin ownership by ETFs and DATs, given easier access, or do we think that that this is still a theme that's going to continue?
I'll
I'll add in. Go ahead.
Yeah, I'll kick off. I think it's an 80-20 rule. I think 80% is distribution, where 20% is probably convenience, from my perspective.
I don't think we've seen the peak yet at all. I mean, just thinking about my own life, I've been in crypto since 2017. 90% of my friends and family still haven't taken exposure. And when they get around to taking exposure, it will likely come in a traditional equity vehicle, either a DAT or an ETF. It's highly unlikely that the newcomers to the space come through a more direct access vehicle.
Yep. I'll go even one step further. I think ETFs are close to the platonic ideal for holding Bitcoin for most investors. And the way you know that is someone like the Abu Dhabi Sovereign Wealth Fund, which has every institution at the tip of its fingers. If it wants Larry Fink to fly over and play pickleball, it just has to ask. They looked around at all the different ways to own Bitcoin. They didn't go direct to a custodian. They didn't poach Brian Armstrong to sit on a ledger in their offices. They bought an ETF. The beautiful thing about an ETF is you can buy the same ETF as the Abu Dhabi Sovereign Wealth Fund. So I think all these other ideas are interesting and they'll scale, but I think we're nowhere near peak ETFs. I think we'll get to $1 trillion of Bitcoin in ETFs eventually.
I'd say from a mathematical perspective, DATs by definition need to keep increasing their buys and increasing the size of their purchases. This is really just because, let's say MicroStrategy, when it first started out, it issued 100 million at 2 times. It was nicely accretive. Now, if they issue 100 million at any multiple, it doesn't move the needle. So if they want to continue to increase their Bitcoin per share at this rapid clip, they need to keep increasing the size of their issuance. So from that regard, who knows if the multiple will hang in there to where they can issue in this accretive fashion. But as long as it does, by definition, they'll just continue to buy or to buy more and more Bitcoin over time.
Well, they've got perpetuals to fund perpetually.
And with those purchases, what do you think is going to happen with consolidation? Going back to what you were saying about these high-performing DATs that do extremely well will continue to do well, and the ones that aren't may get acquired. And what does it look like with these mergers?
I'm very mixed on M&A, and I think the TLDR is it'll come down to market reaction. At first, I was like, it's never going to happen. If you're a seller, why would you ever sell below 1 times when you can sell your commodity digital asset into the market at NAV or at par? If you're a buyer, why would you ever buy something above NAV when you can just turn around and buy that commodity digital asset at 1 times? And then you add in, you've got legal and banking fees and managerial culture issues, and it takes time to close the deals. So I was thinking it probably wouldn't happen. Then the more I thought about it, this train of thought really assumed that you could actually raise capital, and obviously we're in a tougher environment for doing that than we were 2 to 4 months ago. And so if you have an acquirer who's willing to take your stock as compensation, that is essentially a way for you to raise capital. If you are an acquirer and you have a higher MNAV than the company you're buying, by definition, that is accretive to your crypto per share. And so that obviously is a way for you to increase your crypto per share. And then lastly, it could be the case that 1 + 1 equals more than 2. If you put 2 companies together, maybe you have greater visibility, maybe you have greater trading volume, so you can better execute on the capital markets flywheel. And so I think it's going to all come down to market reaction. I think you saw one large deal in the space. It was received quite poorly. I'm sure others will try. I do think if we see 3 to 5 more deals that are received poorly, we probably won't see much M&A, but if you do see the acquirers announce deals and their stock prices move up, I think we could see a wave of consolidation.
Matt, looked like you had something to add there.
No, I thought that was well said. I don't have much to add. I do think bigger is better in this space, so that will itself fuel some M&A in the sense of merging 2 smaller entities to form some strength. I think that makes some level of strategic sense.
I think scale matters. Ultimately, the more AUM you have, the more you can put it to work and generate yield without needing to increase overhead very much at all.
Yeah, I think that's absolutely right. To get back to my mental model of doing something hard, it's hard to have $60 billion of debt-free Bitcoin. That's like a hard thing to get. And as a result, I do think size matters, particularly if there's not much debt overhang there. It's just like organically a good thing. If you gave me $60 billion of Bitcoin, I could generate real income on it.
And even the larger it is, in Solana, when it comes to staking natively, if I had a couple small DATs come together, then they're going to be able to increase their yield on the staking side. And if they just wanted to use the rewards for DeFi composability for higher APY, they can still do it in a way that's never going to touch the principal.
Matt, you mentioned Abu Dhabi, and one of the observations I've had is that the kind of dominance of the U.S. capital markets, in my estimation, is at an all-time high. And as best as I can tell, going back to probably World War II, I've never seen such a outright crushing of the rest of the world when it comes to our capital markets. And I think everyone in the audience has seen. The IPO pipeline is very clearly U.S. dominated, and article after article in places like the Journal and the Financial Times talk about how European and really non-U.S. capital markets are effectively dead relative to ours. How does the absolute dominance of our capital markets affect the DAT and ETF opportunity in the rest of the world, given the fact that while we dominate capital markets, there is in fact a whole world out there? What are your thoughts on the international opportunities?
Yeah, I think that's a fascinating question. I agree on the dominance, and I actually think it will continue, which makes the DATs here the largest, most liquid, and have the most opportunity. You're even starting to see folks like MicroStrategy start to offer offerings for international investors, so I think they will reach out. I do think there are still geographically limited opportunities in markets with capital constraints to accessing Bitcoin, right? The original hard thing that MicroStrategy did was make it possible to buy Bitcoin in a ticker on the New York Stock Exchange. And that's still the case in certain overseas markets. So I think we'll see in regulatorily constrained markets, you'll see DATs emerge that are significant in certain geographies, but the biggest ones are going to be here. This is the most liquid capital market in the world. That matters, particularly in DATs, and so the biggest ones will be here.
Do you think at some point the ETFs will be tokenized to give access to capital constrained areas so they can participate in the markets?
It's very possible that we're thinking about that at Bitwise.
I can speak from my Canadian vantage point. We have had a couple DATs go public in Canada and unfortunately have not performed well. The liquidity just isn't there. And investors broadly have access to everything that's trading and more liquid in the US market. So I think outside of those real market constraints, it's a problem.
We're sailing into, I think those of you who listen to kind of crypto media and or come to occasional crypto events, one of the big buzzwords, which is probably a true kind of topic, is tokenization in 2026. We're seeing consumer platforms like Robinhood and others already talking openly and quite aggressively about tokenizing stocks. And there's this idea that a tokenized security or an otherwise asset is a superior vehicle, allowing cross-collateralization and margining, or all sorts of other benefits of tokenization relative to the underlying security wrapper. A little bit of an odd question, but do we expect to see natively tokenized, so this just came up, tokenized ETFs or tokenized DATs? And it's somewhat of a circuitous construct, obviously, but still worth considering in 2026, given some of the leading companies out there that are doing a pretty good job of tokenizing, such as Superstate and others. What are your thoughts on this notion of tokenizing the vehicle that holds tokens?
We at Upexi have announced our intention to tokenize our equity.
Oh, is that true? Did I steal your material? Sorry.
Well, we have, and a bunch of other treasury companies have as well. We're doing it on Solana through Superstate. In general, I think our current financial system and financial infrastructure is antiquated. These are things like credit card issuer networks and ACH, which were literally created 50 years ago. There are also a ton of intermediaries that are extracting rents in a very big way. And tokenization and stablecoins and blockchain and internet rails allow us to reimagine this antiquated infrastructure, and so tokenization is a very key part of that. We want to support this movement as much as we can. So I do think that is happening and will happen in this coming year.
I could also say that one of the ETFs that's going to be staking with Marinade, that ETF is going to be tokenized in 2026. We just potentially could have been sooner if the government didn't shut down, and we hopefully would have already been launched in the market.
Jaime, any thoughts on that, given your uniquely interesting structure for your DAT?
Oh, look, I think everything is going to be tokenized eventually. I think we're actually going to start to see more real-world assets come online in a meaningful way in 2026. I was giggling a little bit because this was Sam Bankman-Fried's favorite topic right up until the end there. So I like to think about how he's looking at the space evolution from his current.
He's actually listening. He has a live feed.
He may very well be.
Yeah.
I mean, look, I think of course they will be tokenized because people are tokenizing everything from Pokemon cards to DATs. The question is, will they be adopted? I think tokenized assets have seen sort of three vectors of utility. One is solving access, one is solving hours, and then one is solving utility. So access, like foreign listed tokenized stocks, let European investors buy US stocks. Hours, something like BIDL, can be used on the weekends, accrue interest instantly in a way money market funds aren't. And then utility is really posting as collateral or yield in a DeFi network. I don't know that I think DATs fit most on the access vehicle as opposed to the utility or the hours vehicle. And the utility is being the biggest driver of adoption of tokenized assets. So I think people tokenize them, and I think they'll have some acceptance, but I don't think it'll be a huge deal.
In the time we have left, one of the things that I find personally interesting is it feels to me like 2026 at least has the high potential to shape up as a watershed year for our industry, given the regulatory tailwinds that we have now, the additional capital that's come into the space, the comfort that we're seeing from really traditional institutional investors, from the very large banks and the large asset managers all the way kind of across the board. It's a challenging time to think about strategy and to take advantage of whatever forward opportunity you want to define. So rather than a mix of tactics, I was going to ask each of you, what is your number one strategic objective for 2026 to take advantage of each of your individual best forward opportunities, sort of defined as whoever we answer to, your boss or your whoever it may be, your board. What is the one thing that you want to absolutely be sure to accomplish in 2026? That's how I would define it. Maybe with you, Jaime?
Sure. Well, I
want to get it launched
The
first.
number one thing I need to do is get the deal closed, get launched, get funded, get to work.